Bernie Madoff, the $65 billion fraud. In December 2008, a single confession shattered Wall Street. $65 billion. Not lost in a market crash. Not destroyed by bad trades. Not erased by economic forces. It never existed. For nearly 2 decades, some of the most sophisticated investors in the world believed their money was compounding safely under the guidance of a trusted insider. Charities trusted him. Universities trusted him. Hedge funds trusted him. Families trusted him. He was a former chairman of NASDAQ. Respected. Connected. Untouchable. Until the math broke. This is the forensic breakdown of how Bernie Madoff engineered the largest Ponzi scheme in financial history, and why no one stopped him. Section 1. The perfect mask. Bernie Madoff did not look like a criminal. He looked like stability. While markets whipsawed up and down, his clients saw steady monthly gains. Not explosive, not unbelievable, just calm, predictable, controlled. That consistency was not impressive. It was hypnotic, because real markets are messy. But Madoff's statements were smooth, too smooth. And yet, investors leaned into that smoothness instead of questioning it. They didn't demand transparency. They demanded access. Section 2. The strategy that never ran. Madoff claimed to use a split-strike conversion strategy. It sounded technical enough to discourage follow-up questions. Buy blue-chip stocks. Hedge with options. Limit downside risk. It was just complicated enough to feel legitimate. But investigators later discovered something devastatingly simple. There were no trades. No matching options volume in public exchanges. No evidence of large-scale hedging. No custodial independence. The statements were fabricated. The returns were printed. The growth was fictional. The entire performance history was manufactured on paper. Section 3. The engine of the fraud. The structure was brutally simple. New investor money funded old investor withdrawals. That's it. No alpha. No market timing. No strategy. Just cash flow recycling. As long as new money entered the system faster than withdrawals left, the illusion held. For years it did. Because markets were rising. Because trust was high. Because redemptions were manageable. But every Ponzi scheme carries a mathematical expiration date. It is not a matter of ethics. It is a matter of arithmetic. When withdrawals exceed deposits, collapse is inevitable. Section 4. The failure of intelligence. Here is what makes this case more disturbing. Warnings existed. Harry Markopoulos, a financial analyst, calculated that Madoff's returns were statistically impossible. He demonstrated that the options market did not have sufficient volume to support the reported trades. He submitted formal complaints to regulators. Detailed. Structured. Mathematical. They went nowhere. Why? Because reputation overpowered skepticism. Because regulators assumed someone else had already verified him. Because accusing a Wall Street veteran required courage few were willing to exercise. This was not just fraud. It was institutional complacency. Section 5. The psychology of trust. Madoff did not sell greed. He sold exclusivity. Investing with him was a privilege. You needed an introduction. You needed connections. Scarcity increased desire. Social proof replaced due diligence. If major institutions were invested, smaller investors assumed verification had already occurred. No one wanted to be the skeptic in a room full of believers. And so, doubt stayed silent. Section 6. The collapse. Trigger. Then came 2008. Global markets froze. Liquidity evaporated. Confidence shattered. Investors demanded redemptions. Billions in withdrawal requests flooded in. But there was no portfolio to liquidate. No assets to sell. No hedges to unwind. Only incoming money. And during a crisis, incoming money disappears. The engine stalled. The illusion cracked. In December 2008, Madoff admitted to his sons that the advisory business was one big lie. They turned him in. Within 24 hours, he was arrested. The most powerful illusion on Wall Street ended in a single day. Section 7. The aftermath. Estimated losses reached $65 billion, including fictitious gains. Actual principal losses were roughly $17 to $20 billion. Charitable foundations closed. Retirements collapsed. Multi-generational wealth evaporated. Some victims never financially recovered. The damage extended beyond dollars. Trust in financial oversight fractured further during an already fragile global crisis. The scandal forced a brutal question. If someone at the top of the financial system could fabricate decades of returns, what else was fragile? Section 8. The real lesson. The most dangerous risk in finance is not volatility. It is unchallenged consistency. Madoff's returns did not fluctuate because they were not tied to markets. They were tied to perception. Once investors outsourced skepticism, the fraud became self-sustaining. Reputation replaced verification. Comfort replaced scrutiny. And the structure grew large enough that exposure became psychologically inconvenient for everyone involved. Section 9. Executive takeaways. Lesson 1. Consistent returns in volatile markets demand deeper analysis. Lesson 2. Independent custodians and third-party transparency are non-negotiable. Lesson 3. Complexity can be used as camouflage. Lesson 4. Social proof is not due diligence. Lesson 5. Liquidity crises expose structural weakness instantly. Final frame. Bernie Madoff did not hack the market. He hacked trust. He understood that people would rather believe a smooth lie than confront uncomfortable doubt. For nearly 20 years, the illusion held, until the math broke. $65 billion. Not lost, not invested, manufactured. And once reality intervened, the entire structure collapsed under the weight of its own fiction. This is the Case Study Lab, where we dissect how financial empires fall and why. End.